Hello everybody, my name is Rhonna OConnell and I run the London market analysis team for the company StoneX, which is the recent rebranding of what was until last week known as INTL FCStone. I would like to thank Minex Europe for the opportunity to present to you today, and my brief is to look at the prospects for the different metals going forward in the post-COVID era. So what I'm going to do is to show you a summary slide at the beginning and at the end, and in between we'll have a look at the individual metals. So as you can see here, gold has been the outperformer, and frankly we expect it to be the outperformer. This table is ranked according to the degree by which the February and March falls have been unwound, and as you can see, gold is the only metal of those under consideration which has actually gone back into positive territory, and the others have moved by varying degrees. At the bottom of the scale, we have palladium, which has only unwound 26% of its fall. And equally, palladium and platinum were the largest fallers in an outright basis during the movements down in February and March due to their reliance on the automotive sector. So moving on to gold first, I will be fairly swift about these, and then if anybody has any questions at the end, then we will come to talk about it in more depth then. It's been the outperformer amongst its peers and other classes during the pandemic, acting as a hedge against risk. We believe that the virus impact has been fully priced in, as demonstrated by the $40 fall, when it looked as if the EU politicians were actually going to come to agreement with the leaders Angela Merkel and Emmanuel Macron over the secondary rescue package that they were proposing. And gold dropped by $40, and if COVID had not been fully priced in, that would not have happened. Meanwhile, however, other tailwinds remain firmly in place, notably increasing geopolitical tensions, which never actually went away. They merely got pushed out of the spotlight for a while. From the point of view of investment activity, the major action in the markets has been in the exchange-traded funds and what you might call Western investment. And the Western investment predominantly into ETFs has very largely taken up the slack that's been left by the implosion of the physical markets in the Middle East and Asia, which on average over the year 2000 to 2018 inclusive have accounted for 74% of the world's physical fabrication of the metal. Now, I've stopped at 2018 and excluded 2019 for the purpose of this analysis because it was in the middle of 2019 that the physical markets for gold actually fell apart. Silver is the crossover metal between the base and the precious sector. It dances to both tunes. What is important to bear in mind is that it has a legacy of being a currency, and obviously it has jewelry element to it as well, and also when the United States had the dollar on the gold standard, US investors were prevented from holding gold as a private investment, so silver took over as a proxy. That said, roughly 52% of silver's fabrication is in purely industrial usage, and also roughly 80% of its supply is price inelastic. When gold is in a confirmed bull run, then silver will usually go with it, and more often than not outperform. But when gold is directionless, silver takes more notice of the base metal sector, as indeed it did in the first half of 2019 and a good part of the first few months of this year. So looking forward, we need to look not only at the winners, which is basically only gold, but also at the losers. And I've included Brent on this one purely from the point of view of completeness, because oil is obviously very important to the world economy, and indeed vice versa. And there's a clear divide between the performance of gold and the base metals. While gold is up year to date by 12%, and palladium has barely changed. In fact, you can't really even see it on this chart because it's a fraction of 1%. Silver's lagging gold because of the dual nature that we've already looked at, while the base metals vary from 7% for tin, via 8% for copper, nickel and lead, copper and nickel, and lead and zinc between 10 and 11%. Alloy and platinum are down between 13 and 15, and oil, as I've said, continues to suffer, although supply-side adjustments are starting to bring the market into some semblance of order. This, of course, is what's caused all the problems. and the coronavirus, it does now look as if we're heading into a second wave, which just adds to the magnitude of the humanitarian side of this crisis. Now, what I have here is worldwide PMI readings. Now, these tables, I have to say, are as far as May, because as we're putting this presentation together, there are very few June numbers yet through. But I would point out that we're starting to see a little bit of improvement, albeit from a very low base, with France and the United Kingdom both chiming in at above 30 in June. United States was still below. Japan is still down in the mid-30s. So it's still a very fractured exercise at the moment in terms of what is actually happening to the economics as a whole across the system. Now, to put this into context, we can look very simply to kick off with the base metals index for year to date. And this essentially gives the key annotations here. So we had the 2-month lockdown where prices are starting to slide lower. Then we have a period in the middle of April through to early May where pretty much 75% of the globe was in some form of lockdown. Then we had the 2 Chinese political sessions, which brought it back up into what looked like a reasonable economic industrial recovery, although here too there is obviously a degree of uncertainty developing, particularly with the recent outbreak in Beijing of the virus again. So having given you a very quick overview of the base metals performance as a whole, we'll take a very quick look at each of the metals. And the first one is tin. It's largely a story of supply in the first half. It performed poorly last year, with the average price in 2019 some 7% below 2018 levels. And this was predominantly weak demand due to uncertainty from the ongoing trade talks between China and the US, which obviously permeate through all of this as far as history is concerned. But there's more to it than that, because tin's market is actually very well supplied. And to that extent, it was in September 2019, China and Indonesia, the world's 2 largest producers, vowed to cut output by as much as 8% of global supply, although that wasn't in fact actually reached. The drivers from 2019 have reversed, and the virus has obviously hurt the demand side of the equation, although initially, at any rate, it hurt it by less than it did the supply side. And this is actually the case for the majority of the metals, in fact. Copper, we think, is probably the one to watch. At the end of 2019, copper was forecast to be the star performer for 2020, with its long-term bullish outlook for the most part associated with the future of electrification in the auto sector in particular, along with reduced stock levels and forecast weak supply. Now, of course, everything is different. On the supply side, limited impacts from the virus were felt in the first quarter, but it significantly changed in the second quarter, with the virus spreading to the largest mine-producing region of South America. And while the price rally has certainly benefited from this story in April and May, we do believe that the impact has largely been priced in. We are still cautious, though, as a rise in recent weeks of cases in the region could possibly develop into a second wave, and the recent halting of construction at Codelco may well be a sign of more to come. On the demand side, China's speedy pickup in industrial activity has helped the copper price, with demand displayed by higher imports and premium of the metal into the country in April, but readings for May declined. And this could suggest that the much vaunted V-shaped return in demand may not actually be reflective of actual demand, but instead in the filling of delayed orders. Lead. Lead was left behind in the May recovery rally. It's declined last year, like most of the base metals apart from nickel, with an annual average price decreasing by 11%, with plentiful supply and moderate demand. This year, it did have a weak price rally in May due to its unique market structure. It's the only base metal that has a single end use taking up over 80% of its final consumption, which is lead acid batteries, which are important for any internal combustion engine and most hybrid vehicles, as well as marine applications or uninterruptible power supplies. It's also unique in that its secondary production makes up over 2/3 of metal supply, with just 1/3 coming from primary production. This is a factor of lead's poisonous characteristics, where recycling is governed by stringent environmental policies. So the story for lead this year is really one of weak demand. Falling lead production in the first half of this year at about 8% has been offset by plentiful stocks of lead concentrate, while demand itself has been hit on two sides from the lockdown, firstly from the manufacture of vehicle, but also from the impact of people not driving, resulting in traditional change-out demand from lead-acid batteries being much reduced. Now, the nickel market is reliant on stainless steel recovery. Nickel was the only base metal to record a positive price performance last year, with an average gain of 6% over 2018. And this reflected strong demand from stainless steel and lithium-ion batteries, and stocks, as a result, fell to their lowest level since 2012. Supply was also at risk over the year, with expectations that Indonesia would place an export ban on nickel, which they did end up announcing in September for action in January 2020, and this took prices to a 5-year high. Looking to this year, this was meant to be another year of strong demand, especially in the light of signing the Phase 1 deal. But, as it turns out, the situation couldn't be more different. Damage to refined production was limited in the first half, with capacity additions in Indonesia being able to partly offset the weakness in production elsewhere. On the demand side, though, damage to consumption was more severe, falling by 9% on a global basis in the first half, which we've split out at roughly 6% for China and about 12% for the rest of the world. The different approach to lockdown measures in the US and Europe were particularly playing a role in this. As it stands, the 7-year low in stocks at the end of 2019 has reversed, and we now have stocks back up at 2018 levels. Now, in the zinc market, we're looking at demand weakness, which could easily prices tumble. And in fact, very recently, over the course of the last week, we've started to see speculative positions on the London Metal Exchange start to shorten up a little bit as the market starts to look at the weak outlook. We have higher production of both concentrate and zinc metal, reducing the market deficit to its lowest level last year since 2016. But supply tightness has not been a significant driver of higher prices this year. Output, we think, is down by less than 0.5% on a year-on-year basis in the first half, with contraction in the rest of the world at an effectively negligible 1%, unable to offset the pickup in Chinese production, which has been about 3%. Indeed, relatively few zinc smelters on a global scale have had to close, with most, in fact, only reducing their running rates in line with government-mandated restrictions. On that basis, therefore, the metals price improvement that we saw in May was mainly a factor of improving Chinese demand in the second quarter. On a longer-term basis, though, weakness outside China will pull demand down, and we're expecting it to tumble by as much as 9% on a global basis in the first half of this year, to its lowest level since 2011. And this takes us to aluminium, where inventories are still on the rise and could easily rise to record highs by the first half of this year, and certainly by the end of the year. It was one of the worst performing base metals last year, with the average annual price actually falling by 14%. And this is on the back of rising production outside China and a contraction in global demand. Given its major end-use sectors come from construction and automotive, in particular aerospace, COVID has meant we've seen demand almost implode, with aluminium arguably holding the worst fundamentals across the base metals. On the supply side, it was the only base metal to record growth in refined production in both quarters this year so far, with robust production in China offsetting disruptions to production elsewhere. As it stands on a global basis, we're looking at a 2% increase year-on-year in global production. And the reason why Chinese production was so robust is not only because smelting capacity commissioned last year took higher supply into this year, but despite weakened demand, due to costs, smelters themselves were largely kept open, with current utilization rates unchanged on a year-on-year basis. On the demand side, with original equipment manufacturers, extruders, rolling mills, and automotive parts manufacturers all facing partial closures in the first half, particularly in Europe and the States, we forecast that global aluminium demand will fall by 11% in the first half of this year, with the worst falls coming outside China. And although above-ground stock in China has started to be reduced, much of this is the result of restocking of scrap replacement, and we do expect, as I said, inventory levels to be at record highs by the end of this year. That takes us on to platinum, which obviously relies to a great degree on the automotive sector for its for its fortunes. We're looking for platinum to register a surplus of approximately 4 weeks worth of demand this year, as demand destruction is to some extent in line with output losses due to lockdowns in South Africa. And indeed, Impala has actually just raised its production guidance for this year, not by much, by roughly 100,000 ounces. Next year's primary refined production, virus permitting, should actually be higher than in 2009, 2019, partly as a result of pipeline clearance after the Amplat's treatment plants come fully back on stream. One is already back, the other one is not due until the first quarter of next year. Auto catalyst demand, which typically accounts for roughly 40% of platinum industrial demand, is not expected to reach 2019 levels, but may just clamber back to those of 2017. So platinum surplus is likely to expand next year, but nonetheless, we are moderately bullish for the price outlook after the havoc that was wrought this year. And we do expect to see it work its way better, albeit probably not with that much conviction. And now we turn to palladium, which for many moons was the darling of the markets, posting record highs at the start of this year. And this is on the back of at least 10 years of quite deep structural deficits between supply and demand, which has seen an erosion in inventories. And what inventories are left are in relatively firm hands. This has resulted in high and volatile prices and also a degree of illiquidity, which has persisted on and off over the last 2 or 3 years, and nothing is going to change in that particular respect. We do expect it to post a small surplus this year for the first time in as I say, in a decade, but it's likely to go back into a small deficit next year. Now, obviously, we have so many unknowns in the sector at the moment, it's almost impossible to say with confidence what is going to happen in terms of the balance between supply and demand. It could yet still be in a small surplus, but the likelihood is as much as not that it will go back into a deficit. This year, however, we're looking at probably a 25% contraction in demand for palladium in the auto catalyst sector, with heavy falls in China, in the European Union, where we could have sales potentially dropping by 40% this year, and in the United States, we're down substantially, and in April in India, sales were actually zero because the country was in lockdown, and those are the 4 biggest regions in terms of auto demand. That should lead to, as I say, to 25% contraction in palladium demand because we still see increasing loadings followed by thrifting. And on balance, therefore, palladium is set to recover again and to see more volatility and higher prices. One word of caution, though, that I would point out is one of the things that was driving palladium so hard and so fast for much of the latter part of 2019 and the start of this year has been advanced buying out of China ahead of the new emissions limits which come in 2023, which will require unburned hydrocarbon emissions from automotive vehicles to half. And that means a lot more palladium. A lot of it's been bought. So try not to fall into the trap of seeing improved China vehicle outturn in 2021 and 2022, translating directly into a large draw on the international market because a lot of that metal has already been taken out and gone into Chinese hands. And on that note, I will return to the slide that I showed you at the outset, and hopefully I've given you some of the rationale as to why we're looking at what we are looking at for the rest of this year and next year. We do think that aluminium and that nickel can test their old lows, if not take them out. Most of the others are past the worst, but it's difficult to be anything other than bearish for the majority of the base metals for most of the rest of this year and probably into next year. And coming right back to where we started, because of all the geopolitical risk, not to mention the financial and economic uncertainty that we have in the markets, the tailwinds are still in place for gold. So we would expect to see gold to continue to increase. We could even be looking at $2,000 an ounce by the end of next year. And if gold is in a confirmed bull market, then silver will go with it and may well even outperform. So just to finish on the formal note, which the legal side requires of us, there is our disclaimer. Thank you very much for your attention, and that completes the outlook for the metals for the medium term.